All right, welcome back to Two Super Guys Trade Stocks. I'm Vinny,
I'm Dylan.
and today we're going to talk about Michael Burry's portfolio and how he's kind of preparing himself for the hyperinflation that he has been predicting of late. If you haven't seen our other videos, Michael Burry's an interesting guy, a little bit of an enigma, but he, deleted most of his tweets referring to this whole strings. But we've selected a couple and we've pulled them forward, and we also have some quotes from the tweets we don't have actual images of. But he's been talking a lot about kind of the Weimar hyperinflation that was seen after World War One, prior to World War Two. Referenced a book by this Genzo Parsons, which I was able to read this week. Basic premise was that right before the inflation really takes off, there's kind of like a boom, and he's kind of hinted at that's where we might be right now, is in that like boom period. It's interesting.
To be clear, I don't think we're expecting that level of inflation.
Yes,
the World War thing, that was really bad.
Yeah, he has said it is possible, but not yet probable, was his last statement about it, and that was prior to this recent $1.9 trillion stimulus package being passed, or another nice chunk of money being put out there. Yeah.
Which we are also doing a video if anyone's interested in what we're going to do with that precious cash. And me and Vinny are very different.
Yeah, very much so. You guys have probably all seen this graph recently. Dylan kind of alluded to this in one of our videos last week. Basically, it hints at about 20% of the U.S. dollars in existence were created in the last or 2020. Like I said, This is prior to that most recent stimulus package. So they got this nice little kind of hockey stick up top here. The other graph that I don't know if how many people have seen this one, but is this kind of corollary here where this is the velocity of money, how quickly it's changed hands. Basically, the American household has been exhibiting some interesting behavior throughout the whole coronavirus pandemic and all this cash inflow through stimulus, multiple stimulus bills. Credit card debt has dropped across the board. The household savings have gone up. Most of the money that's been pumped into the economy, at least on the individual household level, has kind of stood within the household, right? It's not going out and booking vacations and buying like crazy, I don't know.
No, it's just surviving. They're no one's buying anything.
Yeah, it's nice that people have actually shored up their balance sheet a little bit for their household, which is a nice thing to see. But the kind of reason why this is important is that we haven't seen the full effect yet of those stimulus bills. So as the economy begins to reopen, and now we have this additional one coming forward, we're going to start to see a little bit more of this money that's been sitting in people's checking accounts start to get back out there in the economy. So, one of the classic hedges for inflation is gold, is what people talk about. It's long been considered a store of value, right?
Which I can personally attest does not always correlate.
Yeah, Buffett's not a big fan. He's like, it's pretty funny. We dig this stuff out of the ground, we refine it until it's nice and pretty and shiny, and we bury it again somewhere for a rainy day. He's like, the aliens will think we're crazy.
Yeah.
This is kind of a statement that Burry made from his Twitter account there about what he thought about gold and Bitcoin, how they will be poor competitors when it comes time for inflation, because the government will do whatever it takes to squash them and keep them from being a competitive currency. Because if the U.S. government truly decides to devalue the currency, they'll let nothing stand in their way.
Right.
Yeah.
What does that mean? It takes $3 of debt to create $1 GDP.
Yeah, basically, we were getting smaller and smaller incremental returns. So people were, as a country, we were spending more and more money for getting less and less return, right? It'd be nice if you could spend $1 and get $10 back, right? We eventually got to the point where even before COVID, we were spending $3 in debt to get one additional dollar in increase in our actual production.
So they're not following Dylan's swing trading rule of at least 2 to 1.
Yeah, not so much. But they get to create the money, so it's different rules.
I hate this so much.
This picture?
Yeah, those aren't real, and it's so confusing to people who don't know, because Bitcoin is you can't actually hold it.
Yeah, true. I kind of hope this is made of chocolate.
Someone just made this photo like 10 years ago.
I know, right? Either way, as kind of talking about the previous one, that like Bitcoin is starting to be thought of as like a digital gold, maybe. It's certainly an interesting kind of asset class in and of itself, but same thing. Burry's like it's not his favorite place to kind of put value to protect it from inflation, particularly of late, as he has hinted at. If you don't understand how much leverage was involved to push Bitcoin, which broke $60,000 this weekend, set a new record. It's like you really had no business touching it, because when it's a highly levered asset like that, those are kind of fringe cases where they're that much more exposed to risk. So it's one of the first things people will sell to kind of trim back and shore up their positions, right? So he offered a little bit of not advice for your average American household, which I thought was pretty funny.
Yeah, this is interesting.
Yeah,
this is ballsy.
I mean, yeah, it makes sense though. It's interesting that you basically can take out a 3% mortgage right now and invest that in the stock market, because historically we're going to talk about in a second, but stocks are something that it can be protective to a degree against inflation, right? Because you own something that can increase its own prices to compensate for the devaluing of the currency. But basically, he's saying is like if you have a good value stock, basically something that's producing money and even maybe paying you dividends, and you're purchasing that with something that's a fixed interest rate, pretty secure loan, then it's a little hedge against inflation, right?
Imagine someone reading this and puts it all in like a low float stock that just tanks.
If you really want to like lose your mind, just take out that mortgage and then put it all in one of Dylan's high risk swing trade picks from one of our next videos here,
which are killing it, by the way.
Yeah, maybe you'll either own your entire block or you'll be living in a cardboard box down the street. So
no, it's after we do the losses video, it brought me all the way back.
Wow, geez. All right, stay tuned for that one. All right, so this is kind of a little chart here about what asset classes typically have performed well during inflationary times. Granted, this is based on 1990 to 2020. The greatest inflation in the U.S. economy was back in the 1970s to early 1980, peaked in 1980. But if you look at large cap stocks here, one that usually does relatively well, tips, which is something we can talk about, but and then real estate and commodities are like the two other kind of real well-known hedges against inflation, I guess you could say. Burry, I couldn't find the actual tweet, but he talked about tips briefly, and the reason why he was not a fan of tips is that it's a relatively small market, and I believe it was the Fed is the number one purchaser thereof, so it's really susceptible to market manipulation, was his thought. Yeah, so that was why he was not a big fan. But this is another chart here looking at stock market sectors based on inflationary kind of protection. So ideally you want to stay up here in the blue sections, right? Things that are kind of more prone to issues are these financials and banks and things like that have a little bit of issues with that, right? So here's Michael Burry's most recent 13F filing. I highlighted some companies here in some of the industries that I thought were interesting that it seems like he's kind of seized upon to help protect himself a little bit from inflation there. So utilities and telecom, energy, real estate, and then some of these are actually kind of interesting too. I highlighted red here. Both can fall under real estate, but these are actually two REITs, real estate investment trusts. So they're investments in real estate, and then they also actually own like prison property, basically.
Yeah, he's a fan of prisons.
Yeah, for-profit prisons, particularly. That Genzo Parsons book talks about crime rate going up as well, so that was part of, I believe, his investment thesis behind this move. So this is the second page. You also see some energy stocks and another real estate play here. If you may remember from that previous chart, which I showed you, energy was actually at the top. It's one of the better performing sectors there. Real estate was actually kind of in the middle on that one.
Yeah. You know what's interesting?
What's that?
His biggest stake is in Citi Bank, and Bank was all the way at the bottom.
Yes. So, but that's a call option. I think when these are reported, they're reported a little bit, in a funny manner. He doesn't actually own 539,000 shares of Citigroup. This is a call option on that many shares.
Yeah.
Right. So a call option, he's playing it for a finite amount of time, and it's more of a levered thing. So basically, you use that when you're expecting a large move in a certain direction. During a certain period of time. So these aren't like really true long positions. As you can see, if you are aware, Citigroup has had a decent run actually so far this year. I actually own a little bit of Citigroup. So
I unfortunately didn't buy. I recommended people to buy it though, and then I didn't.
Yeah, honestly, now that I'm like watching his portfolio more and more, his hit rate is pretty good. It seems like at least.
It's pretty impressive.
Wells Fargo is another one that actually I didn't highlight it, but it was another. Well, because it's a bank, but they also had a pretty good move. This is actually a traditional long position, but going back here. So yeah, like I was saying, energy, real estate, those kind of are the plays that he's making at this point in time, which makes good sense from a hyperinflation protective kind of mentality, if you will, at least to me. So like I said, I kind of highlighted these sectors right here. Real estate was neutral on this graph for the most part, but it really depends on where your source is. There are some sources out there that were much more bullish on real estate in terms of protecting from inflation. But overall, I think he's relatively well positioned in to take advantage of a inflationary environment. His exposure to banks and things like that are like you said, call options, and then also
they're not true long term.
Yeah, exactly.
So I guess it kind of depends on when it expires, because if it's like 3 years from now, then
Yeah, exactly. All right. Well, we just want to thank you for tuning in. I don't know if you had anything else to add there, Dylan.
No, honestly, the inflation, the money that's been printed. So it's weird, because if you look up like the inflation rate, it's actually not really crazy. But then you look at total money printed, and it's like way more than what the rate is leading on to be, which is quite interesting.
Oh, that's kind of like that second slide I had there, where we looked at the money velocity. That's part of the reason why you're seeing that split there, where there's a lot of money printed, but it hasn't really had a true effect on a consumer price index level yet. But it's out there. It exists. Like, it has a very real potential to cause it. And as we're starting to see the economy open more and more, like it's going to be interesting. I mean, I am not running for cover by any means, but it's certainly something I'm keeping my eye on.
It is really interesting if you just look up inflation rates. 2020 was actually incredibly low. It was 0.62%, and between 1 and 2 is normal. Now it's at 2.24. But you're right, it's just a weird way to do the metric, because then you look at total money added, and it's like way more than ever at any point. So
yeah, exactly. All right. Well, thank you guys for tuning in. We'll see you guys in the next one.
Have a good one.